Hey everybody, welcome back to the Financial Freedom Show. My name is Rob Berger. In today's episode, I'm going to answer a deceptively simple question. It's a question that seems hard and it's really pretty easy. And it's this: how should you invest $1,000,000? Now, a lot of you may be saying, Rob, that's the last thing I need to worry about. I'm just trying to save $50 a month or $500 a month or whatever. It actually turns out to be, I think, a pretty significant question, and we can learn a lot about ourselves and investing generally by asking this question and answering it, even if maybe it's not directly applicable to you right at this moment. Now, I will tell you, it can come up in some surprising ways. So obviously, you could inherit $1,000,000. You could sell a business, liquidate an investment, some sort of business or other type of investment and have $1,000,000 or $10,000,000, or I don't know. Some of you big spenders, maybe you got $100,000,000 just burning a hole in your pocket, right? But there's another way this can come up, and it's when you retire. So you may save, for a 30 or 40-year career in a 401k or an IRA, perhaps, but a lot of folks have workplace retirement accounts. And when you retire, it's kind of like, what do I do with all that money? And a lot of folks end up rolling it over into an IRA, not necessarily a bad decision at all. And all you've really done is moved it from one account to another. But psychologically, it has a different feel to it now. It's like you're taking this big chunk of money that you had invested in some way for a very long time, usually on your own inside a 401k. You're not using the help of an advisor. You move it over to an IRA, and all of a sudden it kind of feels different. It's like, oh, now what have I done? What do I do with all of this money? Not only is that a big question, but you're not going to start living on it, and it gets really scary. So that's what we're going to try to tackle today. How should you invest $1,000,000? Conceptually, how should we think about it? Another way to ask, I think, a similar question is, how do you invest a windfall? It's kind of the same thing, and it may not be exactly $1,000,000 for you. Maybe it's 50,000, 500,000, or as I said, 100 million. Here's the thing. I think the answer is the same regardless of the amount of money. Now, a lot of people would disagree with me on that. In fact, let me show you my computer screen here. I'll put my ugly mug in the corner. There we go. This is Chewy's founder, right? Ryan Cohen. He had a big liquidity event, and this was just last year. He piled most of $3.4 billion, that's with a B, into just two stocks, Apple and Wells Fargo. That was it. $3.4 billion. We're going to just shove it. All our chips are on the table. We're just going to shove them into Apple and Wells Fargo and call it a day. By the way, his name has come up more recently because he joined GameStop. And of course, you all know the craziness behind that stock and Wall Street bets and that whole story. But it was interesting to me that he would put all of that money into just two stocks. Of course, you could say before that, all his wealth was in one company. So it's, in some ways, you could say he diversified. And you could also say, yeah, but he's got like $3 billion. So does it really matter? I mean, even if the investments turned out to be horrible, he's still going to be fine. True enough. But I want you to know I searched high and low for answers to this question, even went, of course, to Reddit. And there was a question that someone asked in Reddit, and it was, how do you invest, $1,000,000? My favorite answer, and I went through like over 100 replies just to get an idea of how people think through this question. And my favorite answer among all of them, and now of course I can't find it, so let me search for it. Oh, here it is. It's right here. You are on Reddit, a majority of basement dwelling individuals, asking them what to do with $1,000,000. You are doomed. That seems about right. So that's the context of the question. We're going to answer it today. And I think to begin with, we should understand why it's hard. Why is investing a windfall, $1,000,000, so difficult? And I think there are a couple of reasons. The first one is what I call the small big dilemma. And I call it that because I'm just not creative enough to give it a better name, but it's the small big dilemma. Let's think about it this way. Most of us don't just fall into $1,000,000. So you invest maybe, let's say in an IRA, it's $6,000 a year. You're investing mainly in mutual funds, probably, maybe ETFs. And you do it year in and year out. And depending on your returns, in roughly 20 years, you're a millionaire. Here's the thing. You accomplish that one small step at a time, right? There was never some big mass event where you had, several $100,000 to invest. It was usually $50 a month, $100 a month. If you're doing $6,000 a year, maybe it's $500 a month or once a quarter or whatever. The point is, all of these decisions are relatively small. They're relatively insignificant. We don't normally fret over, how do I put $500 to work? You just stick it in the IRA wherever you've got it, and you invest it. Again, 3 fund portfolios, 6 fund portfolio. Maybe use a robo-advisor, whatever. It's not like it's a big deal. And just slowly over time, you wake up and you look at your account. And one day it's over $1 million, and at that point you don't stop and say, "Wow, $1 million bucks. Now what do I do? How do I invest it?" You just kind of maybe marvel at the amount. Maybe you tell your significant other, then you just go about your day. It's not a big deal. On the other hand, if you're given $1 million bucks, again, it could be inheritance, you sell a business, whatever, that feels completely different. Even though the end result is the same. In both scenarios, it's $1 million bucks. When you get it all at once, emotionally, psychologically, it's different. And I think we tend to put a lot of pressure on ourselves. It's like, well, don't blow this. You got $1 million bucks, you got to get this right. Yes, it's important. Yes, we do want to get it right. But what I want to kind of convey today is that I think the best approach to investing is the same. Whether you're investing $500 a month, or you get $1 million bucks, or even $100 million at one time, I don't think the approach should change. And I'll explain the details in just a minute. That's the first thing that makes investing a windfall or $1 million bucks difficult. The second thing is what, again, sorry for the names, the road less traveled dilemma. And the idea is this: when you come across a windfall, it often coincides with a big event in your own life. So again, you have a business and you sell it. That's a big life change. It's not just about the money. It's about, now what am I going to do with my life? And so you're not just answering the question, how do I invest this money? You're answering even more profound questions about your future. I think that's the same thing if you inherit money. Maybe you've lost a loved one. Maybe it could be insurance proceeds, right? Your spouse passed away and you've inherited or received a life insurance payment. And so you're dealing with the emotions of that loss and what your life is going to be like, in the days, weeks, and months and years going forward. The same is true when you retire. That's obviously a big life event. You've left your career, and now what's next? So in answering this question, we're often dealing with a lot more than just dollars and mutual funds. And that, I think, can add a lot of pressure and anxiety to the decision. The third thing, and it's related, and that has to do specifically with retirement. I can speak from experience on this. You can read all the retirement books you want. You can have all of the plans. You can know the 4% rule backwards and forwards. That's great. But when it comes to actually retiring and living off of your nest egg, it's scary. And that's true even if you can live off of well below 4%. And again, I'm speaking from experience. We're not living off our nest egg at the moment. We ended up just fortuitously getting some work that helps us pay for our expenses. I wasn't planning that when I sold my business 2 years ago. And I can tell you there's a big fear of starting to live off of your nest egg. So again, you're dealing not only with the investing decisions, but sort of the bigger sort of life questions. Now, that's what makes it so difficult. I think it also, though, helps us get to the right answer on actually how should you invest $1 million bucks? How should you invest a windfall? And when we're doing that, I think there's sort of 3 questions, high-level questions we should at least think about, and then let's get to the specifics. So what are the 3 questions? The first, of course, are your short-term liquidity needs. If you're going to need money in the next 5 years, I would pull that out of investing. If I've got a big windfall, a lot of money, but I'm going to renovate the house, or I'm going to take a trip around the world, or a son or daughter is getting married, or there's some big expense, you're going to need the money. I pull that out immediately. That's not going to get invested because the volatility of the market. You need to set aside. In my mind, it's 5 years. It's not set in stone, but that's kind of what I'm comfortable with. Whatever you choose, think about what you're going to need over the next several years to pull out of that money before you invest it. That's the first thing, right? The second thing is lump sum versus dollar cost averaging. Whatever you have left that you're going to invest, you just shove it all in, your chips go right in, just push your chips into the middle of the table. Or do you do it, over 12 months or 24 months? I've done a video on this. I won't get into the details again. I'll link to the video below. I will just say briefly, the math and history tells us lump sum investing is probably, it has a greater chance of a better result. But at the same time, I think our own fears and sort of the psychology of it can make dollar cost averaging better for a lot of folks. At the end of the day, I wouldn't lose a lot of sleep over your decision. Again, that being said, I'll link to a video below that goes into more detail on that issue, but it's an important one. I can tell you when I had the liquidity event in 2018, I sold part of my business, basically doubled the amount of money we had to invest. I chose lump sum. It worked out for me, yeah, but it could have worked out the other way and been not as good an outcome. Maybe I just got lucky, I don't know. But it's an important decision. It's one that you should give some thought to. I'll link to the video. And then the last thing is to consider before we get to specifics are your investing goals. And here's what I mean about that. I'm not talking about life goals. Are you going to retire or not? Obviously, those are important. But rather, how involved do you want to be in the investing process? Right? Some folks view investing as sort of a calling, right? And they do that because in part, they want to give a lot to charity. And they want to be very involved in their investments. So for a lot of these folks, they're investing in real estate and helping manage the real estate. They're buying private businesses and getting involved in those businesses. That's one extreme. Another type of investor is someone who's actively engaged in analyzing stocks and investing in individual stocks. Again, that's a certain kind of personality, interest. I think a lot of folks are the exact opposite. It's like, look, I don't want to spend a lot of time with my investments. I just want to put them in something that makes sense, maybe review it once a quarter, whatever, and then go about doing other things in my life. There's not that there's a right or wrong here. The key is to understand where you want to be within that sort of continuum of investors and what your goals are for investing. So having said all of that, as I like to say, enough chit chat, let's get right to how you should invest. I hope this surprises absolutely none of you watching this video, at least if you've watched any of my past videos. I think the starting point is the Buffett portfolio, which is why I did the last video called the Warren Buffett portfolio. If you haven't watched it, it's pretty simple. He proposes a two-fund portfolio for the average investor, 90% an S&P 500 index fund, 10% a short-term U.S. government bond fund. And what he says is that kind of low-cost portfolio will outperform the vast majority of pensions, hedge funds, institutional investors, or anyone else who pays a large fee to have someone manage their money. Now, one thing I want to stress is I don't think the important point to take away from the Warren Buffett portfolio is the specific portfolio, 90% in S&P 500, 10% in short-term government bonds. The real key takeaway is twofold. Low-cost investments that cover the market, right? And that are heavily weighted to equities. Doesn't mean it's got to be 90-10, could even be 60-40. But to me, those are the two big takeaways from the Warren Buffett portfolio. I will add, I've done a lot of work on the 4% rule. I've recorded a lot of videos on it. And if you've watched them, you know that Bill Bengen, who was sort of the father of the 4% rule, he published the first paper in 1994 that sort of introduced what we now know as the 4% rule. He effectively used the Warren Buffett portfolio. It wasn't called that at the time. Warren Buffett didn't write about this until the 2013 Berkshire Hathaway shareholder letter. But his primary portfolio, when he was doing his 4% analysis, was S&P 500 index, and he used intermediate term U.S. government bonds, not short term, but that was it, two classes. And he looked at different allocations between those two classes and coming up with the 4% rule. He basically found that for the 4% rule to work, you want 50 to 75% in stocks and the rest in bonds. So again, a portfolio that is weighted in favor of equities. So in some ways, there's a lot of similarity between the Warren Buffett portfolio and what Bill Bengen did with his paper in 1994. Now, since then, a lot of academics have done a lot of work on the 4% rule and have suggested other asset classes, including Bill Bengen himself. And so that gets me to sort of the next step. I think the Warren Buffett portfolio, that is low-cost index funds that are weighted more towards equities than bonds is the absolute starting point and should be the foundation of an investment portfolio. That would be true if I had $100 million to invest. I would not invest it differently than how I would invest $1 million or $500,000. That would be the core. Now, in my case, I prefer a little more diversity. So I prefer, at a minimum, the 3-fund portfolio, and what it adds is international exposure. So again, a Vanguard International Index Fund or a Fidelity International Index Fund. I've done a video on the 3-fund portfolio. I'll link to it below this video. That, to me, I just feel more comfortable having exposure beyond just the S&P 500 index. Frankly, I don't think it will outperform the 2-fund portfolio, but I do think it probably smooths it a little bit. That would be my guess. Of course, time will tell. And I just take some comfort in a little more diversity. I think a 3-fund portfolio, it would make absolutely perfect sense to take $100 million and put it in a 3-fund portfolio. Simple as can be. Now, that's not what you'll hear. If you go to a high-cost investment advisor, that's either a commissioned broker who's going to make a fortune by selling you, non-traded REITs and expensive insurance products, you're not going to hear this from them because a 3-fund portfolio won't make them any money. You're going to hear complicated investment strategies. You'll hear the same thing from expensive advisors who just charge a percentage of assets under management. Many of them, by the way, are fiduciaries, right? They're not going to make any money if you just want to stick $1 million in a 3-fund portfolio. They have to complicate it, and they will. And in fact, when I sold my business, I sat down with a fiduciary, someone, a registered investment advisor who charges a percentage of fees under management. They wanted to put me in expensive, complicated real estate transactions. They wanted to put me in, my favorite was the Black Swan portfolio. I said, well, that's interesting. Tell me about the Black Swan portfolio. Well, this will help you in case of a Black Swan event. And I said, you mean those events that can't be predicted? Yeah, right, those. So how do you have a portfolio that's going to protect me against an event that we don't know what it is and can't predict it? Silence. Anyway, that's all nonsense. A 3-fund portfolio is a great core foundational portfolio for $1 million, for $10 million, for $100 million. Now, I tend to use what's called a 6-fund portfolio, and let me kind of just show you some of this on the screen. This is me not logged into M1 Finance. Let me try it again. Here we go. Here are some portfolios I've put together. I've linked to them in the past. I'll link to it again. This was the Warren Buffett portfolio that I put together for the last video. Here's the 3-fund portfolio, and it's very, very simple. You can see at the bottom, I can't bring it up any higher than that, but it's 50% in a Vanguard total stock market ETF, 30% in international, and then the rest there in a total bond market. I tend to use, for my own investing, the 6-fund portfolio, and it adds exposure to REITs, small cap value, and emerging markets. Now, is this necessary? No, I think a 3-fund portfolio would be perfect. So then why do I do this? I just take a little more comfort in having the added diversity. And I think I think what the added diversity will do, it will in theory give me the potential to maybe perform a little better than the 3-fund portfolio. Although again, time will tell. And I think even though many of these asset classes are very volatile, think emerging markets, very volatile, small cap, same. When you put together volatile assets that don't move in lockstep, then I think you actually can smooth out the overall volatility of the portfolio. If you've ever seen the Seinfeld episode with Elaine Bennis dancing, that's what you want your portfolio to look like. You want one asset class, going over here and then another one going over there. Is this how she danced? Something like that. Anyway, you don't want your portfolio to look like Ginger Rogers and Fred Astaire. And for you young folks, you're just going to have to Google who they are. You want your portfolio to dance like Elaine Bennis. And so that's kind of like why I like the 6-fund portfolio. But honestly, a 3-fund portfolio, I think, would be great. And that's how I invest my money. Now, I will say in sort of a last thought on this video is that if there's part of you just have an itch you need to scratch, you just need to invest in some stocks, or you just need to do some day trading, or you just can't help but invest in some Bitcoin, I think what's important is to wall off those investments. Say, okay, I'm going to put 5% or 10% of my portfolio, and I'm going to invest in this. And that's effectively what I've done. I invest some in individual stocks. It started out as 5%. I'll be honest, it's done really well. And so it's now about 15% of my portfolio because it's grown, largely because of Apple. I don't own a lot of stocks. For a long time, it was just Apple and Berkshire. Since I've added Wells Fargo and Bank of America, and in 6 months, I've earned like 60%, which scares me a little bit because I have to keep reminding myself that doesn't make you a great investor, and it doesn't. It makes you lucky. Now, if I do that over the next 40 years, then maybe I'll reassess that. But my point is, if you've just got to invest in something, because it's fun, whatever, that's great. But just figure out a relatively small percentage, invest it that way, and then the rest should be in low-cost index funds. Now, again, for some of you, you may just enjoy buying real estate, and that's terrific. Just figure out what percentage of your portfolio you want to put towards real estate. I have a cousin who sold a restaurant many years ago in Blacksburg, Virginia, and he took his money and he bought homes and he fixed them up and he rents them to students at Virginia Tech, and he's been doing that for years. The students love him because he makes the places he builds are just incredible. I mean, they're really nice. And he's done very well for himself. So if you have a passion for something like that, I think that's terrific. But for those that want to just, invest, forget all the fanciness. Forget the private equity and the hedge funds and, the expensive investment advisors. The odds of beating a low-cost index fund approach over the long terms are practically 1,000,000 to 1. I mean, you're just not going to do it. Now, the question still remains, what if you want help? And I understand why you would, and I have family members and friends that talk to me about this. They want help. So I have a couple of things here that I want to give you as we bring the video to a close that I think could help you. The first is you really need to avoid commissioned brokers and expensive registered investment advisors that want to charge you a percentage of your assets under management. And sort of my rule is you don't want to pay anyone more than 50 basis points. That's at the high end. And most registered investment advisors, these are fiduciaries, are going to charge you more than that. They're going to charge you 1% or even more. It just doesn't make any sense. You're giving away too much wealth. And there are plenty of alternatives. Vanguard offers advisory services for 30 basis points. So that's one option. And there are plenty of hourly folks that will work with you to help build a portfolio and charge you just an hourly fee. I work with Mark Zorel, and he's been great. I don't have any financial relations with, I don't get paid to say his name in this video. In fact, I pay him, and he doesn't manage my portfolio. And in fact, he hasn't even built my portfolio. I did, but I like to talk to him once or twice a year and just get his take on different issues like Roth conversions and the market and my portfolio. And so I do that. So there are plenty of options. My point is there are plenty of options for finding really good, low-cost advice. And if you're going to get help, I think that's what you should do. The last thing is there are some books. If you want to sort of start learning on your own, hopefully you're learning something from these videos, and thank you for watching. The channel has grown 10x over the last year in terms of subscribers and traffic and views, so I'm grateful for that. But there are some books. Now, I've written a book, Retire Before Mom and Dad, and I like the book. I hope you do too if you've read it, but that's actually not one of the books I'm going to recommend for this specific purpose, because that book really isn't about investing a windfall or $1,000,000. It's about how to go from nothing to financial freedom, which is different. So let me show you the books that I would recommend as a starting point. I've got them on the screen here. The first one is, and I'd start with this one, The Boglehead's Guide to Investing. Bogleheads, great forum, by the way. Just Google Bogleheads forum, and it's a great forum, and it's named after Jack Bogle, the founder of Vanguard. I've got this book. I've read it. Excellent book, and really all you really need to know, to be honest with you. Great book. The other one, this is an older one, The 4 Pillars of Investing by William Bernstein. This was one of the books I read many years ago. And this says 2010. I think the original is actually older than that. This might be an updated version, but I think it's a good, solid book to understand investing. and portfolio construction. And then the last one is actually by John Bogle himself, The Little Book of Common Sense Investing. A great book. And honestly, I think these three books can tell you everything you need to know. The big takeaway that I hope you hear is this. Investing $1 million or some other windfall is really no different than investing $500 a month in an IRA or investing $10,000 or whatever. The market, the industry, they'll tell you it's different. Oh, $1 million. Well, now we need to get sophisticated with how we invest. No, that's just, all that does is it lines the pockets of advisors and what Warren Buffett calls helpers. It doesn't actually make you wealthier in the long run. Investing $1 million is no different or more difficult than investing $10,000. That's the real takeaway. So if you're lucky enough to have this problem, I wish you the best. Keep learning, keep educating yourself. Watch those fees. If you need help, get low-cost help. I think some of the books I've mentioned can help you. Hopefully some of my videos have helped you too. If you have questions, leave them in the comments below. Would be happy to help you out any way that I can. And until next time, remember, the best thing money can buy is financial freedom.